If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family help us spread knowledge. And when we help others grow, we grow too. Thank you so much for listening. Let's dive into the audiobook. Chapter 1, Foundations of Intelligent Investing. Part 1, Investment versus Investing. Speculation. When Warren Buffett calls Benjamin Graham's distinction between investing and speculation by far the most important concept in the book, smart money pays attention. Yet most people stumble into markets without grasping this fundamental difference, confusing activity with achievement and mistaking price movements for investment returns. Graham's definition cuts through market noise with surgical precision. Investment, he argues, requires three essential elements: thorough analysis of the security and company, protection of principal, and adequate return expectations. Remove any of these components and you shift from investing to speculation. This framework saved countless investors during the dot-com bubble, when companies with no profits commanded billion-dollar valuations. Consider the tale of two approaches during the 1999 technology frenzy. Speculators chased Pets.com stock from its IPO price of $11 to peaks above $14, driven by dreams of revolutionary pet food delivery. Meanwhile, Graham disciples like Warren Buffett faced criticism for avoiding tech stocks entirely, sticking to undervalued companies with proven earnings records. When the bubble burst, Pets.com became worthless within months, while Buffett's boring investments like Coca-Cola continued generating steady returns. The speculation trap often disguises itself as sophisticated analysis. Day traders armed with charts and technical indicators convince themselves they're making informed decisions. Yet Graham observed that short-term price movements follow no predictable pattern. The stock market serves as a voting machine in the near term, reflecting popularity contests rather than business fundamentals. Only over extended periods does it function as a weighing machine, measuring actual corporate value. Graham witnessed this principle during the Great Depression, when solid companies traded for less than their cash holdings. Speculators who bought based on recent price trends suffered devastating losses. Patient investors who analyzed balance sheets and bought below intrinsic value eventually prospered as markets recovered and recognized true worth. The emotional component separates investors from speculators most clearly. Speculation feeds on excitement, hope, and fear. When GameStop stock soared 1,625% in January 2021, retail speculators bought based on social media momentum rather than business analysis. The company's fundamental challenges remained unchanged, yet price action drove decisions. True investors evaluate whether GameStop's transformation plan justified any purchase price, regardless of recent movements. Graham's framework provides protection against this emotional turbulence. Before buying any security, ask three questions. Do I understand this company's business model and competitive position? Can I afford to lose this investment without jeopardizing my financial security? Will this investment provide returns that justify the risk over time? These questions transform market participation from gambling into disciplined wealth building. The difference determines whether you join the 90% who lose money trading or the minority who build lasting prosperity through patient, analytical investing. Part 2, The Investor and Inflation. When Warren Buffett encountered his first serious bout with inflation in the 1970s, he discovered something unsettling about his Coca-Cola holdings. Despite the company's strong business performance, the real purchasing power of his dividends had shrunk considerably. A dollar received in 1970 could buy what required $1.50 by 1975, effectively cutting his income by a third without him selling a single share. Inflation operates like a hidden tax on every investment decision you make. While your bank statement might show steady growth, the groceries that cost $100 last year now demand $103. That seemingly modest 3% increase compounds mercilessly over time. Money sitting in savings accounts earning 1% interest actually loses 2% of its buying power annually when inflation runs at 3%. The challenge becomes more complex when considering different asset classes. Bonds, traditionally viewed as safe investments, performed poorly during the inflationary 1970s. Investors holding 30-year Treasury bonds watched their real returns turn negative for extended periods. Meanwhile, companies like McDonald's and Johnson & Johnson, with pricing power and growing earnings, provided better inflation protection despite appearing riskier on paper. Real estate investment trusts demonstrated another approach during this period. REITs like Boston Properties could raise rents alongside inflation, passing increased costs directly to tenants. Their distributions often exceeded inflation rates, preserving purchasing power while generating income. However, this strategy required careful selection, as over-leveraged REITs faced severe difficulties when interest rates climbed. Graham's approach to inflation protection emphasized companies with strong competitive positions and minimal capital requirements for growth. See's Candies, acquired by Buffett in 1972, exemplified this principle perfectly. The company could raise chocolate prices annually without losing customers, requiring minimal additional investment to maintain operations. Compare this to steel companies, which needed massive capital expenditures just to maintain production capacity, making inflation protection nearly impossible. The stock market's relationship with inflation proves counterintuitive. Mild inflation often benefits stocks by supporting corporate earnings growth. However, high inflation creates uncertainty about future cash flows, leading to lower valuations despite rising nominal earnings. During periods of severe inflation, investors often flee to tangible assets like commodities or real estate, creating opportunities in undervalued stocks. Consider your investment timeline when planning for inflation. Short-term investors might accept lower nominal returns from Treasury inflation-protected securities, which adjust principal values based on consumer price changes. Long-term investors often benefit from stock ownership in quality companies capable of passing increased costs to customers. The key lies in recognizing inflation's inevitable presence rather than trying to predict its timing or magnitude. Building portfolios with natural inflation hedges through diversified ownership of productive assets provides more reliable protection than attempting to time economic cycles or chase inflation-focused investments after prices have already risen substantially. Part 3. Stock Market History and Perspective. When Warren Buffett first read Benjamin Graham's work in the 1950s, the stock market had just recovered from the devastating crash of 1929. Yet most investors still treated each market swing as unprecedented. Graham's historical analysis revealed a crucial truth that transforms how intelligent investors view market behavior. What seems extraordinary today often represents ordinary cyclical patterns when viewed through the lens of decades rather than months. The stock market's journey from 1871 to 1971 demonstrates remarkable consistency, despite appearing chaotic to contemporary observers. During this century-long period, the market experienced 17 distinct bull markets and 16 bear markets, with the average bull market lasting 2.5 years and producing gains of 120%, while bear markets averaged 1.1 years with losses of 30%. This pattern held true through world wars, economic depressions, and social upheavals, suggesting that market cycles operate independently of specific events that capture daily headlines. Consider the market's behavior during the 1960s, when many investors believed technology stocks represented a permanent shift toward endless growth. Companies like IBM and Xerox commanded price-to-earnings ratios exceeding 50, as investors extrapolated recent performance into perpetual prosperity. Graham observed similar enthusiasm during the 1920s before the crash, and again in the late 1940s when post-war optimism drove valuations to unsustainable levels. Each generation of investors seemed convinced their circumstances were uniquely favorable, ignoring historical precedents that suggested otherwise. The most dangerous investment mistake involves projecting short-term trends indefinitely into the future. Graham documented how investors consistently bought stocks at peak valuations after extended bull markets, then sold at depressed prices following market declines. This behavior persisted across decades because each generation experienced market cycles as novel, rather than recognizing them as variations on familiar themes. Historical perspective provides emotional inoculation against market extremes. When the Dow Jones Industrial Average fell from 381 in 1929 to 41 in 1932, investors who understood previous market cycles recognized the decline as severe but temporary. Those lacking historical context viewed the crash as evidence that stock ownership was permanently dangerous. Similarly, during the go-go years of the 1960s, investors with historical awareness questioned whether growth stocks could maintain valuations that exceeded all previous benchmarks. Graham emphasized that market history teaches humility rather than prediction. While specific timing remains unpredictable, the alternating pattern of optimism and pessimism creates recurring opportunities for patient investors. Understanding this cycle helps investors maintain emotional equilibrium during both euphoric bull markets and despairing bear markets. Recognizing each extreme as temporary rather than permanent, the lesson extends beyond market timing to fundamental investment principles. Historical analysis reveals that companies with strong balance sheets, consistent earnings, and reasonable valuations tend to survive market cycles better than highly leveraged or overvalued enterprises. This pattern suggests that focusing on business fundamentals rather than market sentiment provides more reliable long-term results, regardless of which specific cycle investors experience. Part 4. The Margin of Safety Principle. When Benjamin Graham watched the devastating 1929 stock market crash wipe out millions of investors who thought they were following sound principles, he realized something fundamental was missing from conventional investment wisdom. The answer would become his most important contribution to finance: the margin of safety principle. Think of margin of safety like the engineer who designs a bridge to hold 10,000 pounds, but only expects it to carry 5,000 pounds. The extra capacity protects against unexpected stress, measurement errors, or material flaws. Graham applied this same logic to stock purchases, insisting investors should only buy securities priced substantially below their calculated intrinsic value. The principle emerged from Graham's painful personal experience during the Great Depression. Despite his analytical skills, he suffered massive losses because he had paid full price for stocks based on optimistic projections. This taught him that even the most careful analysis contains inevitable errors, and external events can devastate the best-laid plans. Consider Graham's approach to railroad bonds in the 1930s. Rather than buying bonds at par value, he sought issues trading at 50 cents on the dollar, while the underlying railroad assets were worth significantly more. Even if his analysis proved partially wrong or the company faced unexpected difficulties, the substantial discount provided protection against loss. The margin of safety serves three critical functions. First, it compensates for human fallibility in estimating intrinsic value. Financial analysis involves numerous assumptions about future earnings, growth rates, and economic conditions. Even experienced analysts frequently miss important factors or make calculation errors. Second, it provides cushioning against unfavorable developments that could temporarily depress a company's business. Third, it creates the potential for satisfactory returns, even if the security never reaches its full calculated value. Modern examples demonstrate this principle's enduring relevance. Warren Buffett's 1988 purchase of Coca-Cola occurred after the stock had declined significantly, trading at what he considered a substantial discount to its intrinsic value based on the company's powerful brand, global distribution, and consistent cash generation. Even accounting for possible analytical errors, the purchase price provided adequate protection. The challenge lies in calculating intrinsic value accurately while maintaining realistic assumptions. Graham emphasized analyzing companies with stable earnings histories, strong balance sheets, and predictable business models. Speculative growth stocks, regardless of their potential, rarely offer sufficient margin of safety because their valuations depend heavily on optimistic future projections. This principle directly addresses the market cycles discussed previously. During euphoric periods, finding securities with adequate safety margins becomes extremely difficult as prices inflate beyond reasonable valuations. Conversely, pessimistic periods often create numerous opportunities as fear drives prices below intrinsic values, providing exactly the protection intelligent investors require. The margin of safety transforms investing from gambling into a disciplined process where favorable odds replace hopeful speculation. Chapter 2: Building a Portfolio, Defensive and Enterprising Approaches. Part 1: The Defensive Investor Strategy. When Warren Buffett calls Benjamin Graham's defensive investor approach a sound intellectual framework for making investing decisions, he's referring to a strategy that has protected millions from market devastation while generating steady wealth. The 1929 crash wiped out speculators overnight, but Graham's defensive principles emerged from studying exactly how conservative investors could avoid such catastrophes. The defensive investor strategy operates like a well-engineered bridge, built to withstand storms rather than win speed contests. Consider John Bogle's application of these principles when he founded Vanguard in 1975. Rather than chase the latest investment trends, Bogle created index funds that embodied Graham's defensive philosophy: broad diversification, low costs, and minimal speculation. The results speak volumes. Vanguard's total stock market index fund has returned an average of 10.3% annually since inception, outperforming most actively managed funds while requiring virtually no investor involvement. Graham's defensive approach centers on 4 fundamental rules that sound almost mundane in their simplicity. First, maintain adequate diversification by spreading investments across at least 10 different industries. Second, select only large, prominent companies with long records of continuous dividend payments. Third, limit the price paid for stocks to no more than 25 times average earnings over 7 years. Fourth, maintain a balanced allocation between stocks and bonds, typically ranging from 25% to 75% in each category. The beauty of this approach becomes apparent during market turbulence. During the 2008 financial crisis, investors following Graham's defensive principles experienced significantly smaller losses than those chasing speculative investments. The defensive investor's portfolio of blue-chip dividend stocks like Coca-Cola, Johnson & Johnson, and IBM weathered the storm because these companies possess the financial strength Graham demanded: consistent earnings, strong balance sheets, and established market positions. Real-world application proves remarkably straightforward. Take someone investing $500 monthly using Graham's defensive strategy. They would purchase shares in a diversified portfolio of established companies trading at reasonable valuations, reinvest dividends automatically, and largely ignore daily market fluctuations. This investor avoids the exhausting cycle of research, analysis, and decision-making that consumes enterprising investors. The defensive strategy acknowledges a fundamental truth about investing: most people lack the time, expertise, or temperament for active investment management. Graham designed this approach for busy professionals, retirees, and anyone preferring financial security over market-beating returns. The strategy accepts modest returns in exchange for peace of mind and reduced risk of permanent capital loss. Modern research validates Graham's insights. Studies consistently show that low-cost, diversified portfolios of quality companies outperform the majority of actively managed investments over extended periods. The defensive investor's patient, methodical approach transforms investing from a high-stress speculation game into a systematic wealth-building process that works regardless of market conditions or economic cycles. Part 2: Common Stock Policies for Defensives. When Warren Buffett first read Benjamin Graham's teachings on common stock selection in the 1950s, he discovered a simple truth that would make him billions. The most reliable profits come from buying ordinary pieces of extraordinary businesses at reasonable prices. Graham's framework for defensive stock selection proved so effective that Coca-Cola, one of Buffett's largest holdings, exemplifies every principle Graham advocated decades earlier. Graham's defensive stock policy centers on a revolutionary idea that contradicts Wall Street's complexity. Instead of chasing hot stocks or trying to time markets, defensive investors should focus on companies so stable and profitable that they practically run themselves. Think of these investments as owning a piece of the local electric utility or telephone company during their monopoly days. Businesses that generated cash regardless of economic conditions. The first requirement involves company size and market position. Graham insisted on large, established corporations with substantial assets and market dominance. He witnessed how companies like General Electric and IBM weathered multiple recessions while smaller competitors disappeared. During the 1970s oil crisis, Exxon's massive reserves and global infrastructure protected shareholders while smaller energy companies collapsed. Size provides defensive moats that speculation cannot replicate. Financial strength forms the second pillar. Graham demanded companies with current ratios above 2.0 and debt levels below 50% of net current assets. Johnson & Johnson exemplifies this principle, maintaining strong balance sheets that enabled strategic acquisitions during economic downturns when competitors struggled with debt burdens. Conservative financing transforms market volatility from threat into opportunity. Earnings stability represents perhaps Graham's most crucial filter. He required 10 years of continuous earnings, understanding that consistent profitability indicates genuine business strength rather than accounting manipulation. Procter & Gamble's unbroken dividend payments since 1890 demonstrate how stable earnings translate into reliable returns. Companies that maintain profits through multiple business cycles prove their competitive advantages. Dividend policies reveal management's commitment to shareholders. Graham favored companies with 20-year dividend histories, recognizing that consistent payments require both earnings stability and shareholder-focused leadership. Microsoft's transformation from a growth company hoarding cash to a dividend-paying mature business illustrates how the best companies eventually reward patient investors with steady income. Valuation discipline prevents defensive investors from overpaying for quality. Graham's price-to-earnings ratios below 15 and price-to-book ratios under 1.5 seem restrictive, but these limits protected investors during speculative bubbles. Those who followed these guidelines avoided the worst losses during the dot-com crash and 2008 financial crisis. Why do professional investors often ignore these seemingly obvious criteria? The answer lies in career incentives. Fund managers face quarterly performance pressures that make steady, unglamorous returns seem insufficient. Defensive investing requires patience that conflicts with modern portfolio management's short-term focus. Yet historical evidence consistently validates Graham's approach. Boring, well-capitalized companies with predictable earnings and reasonable valuations generate superior long-term returns while minimizing permanent capital loss. This methodical selection process transforms stock picking from gambling into business ownership, creating wealth through compound growth rather than market timing speculation. Part 3. Enterprising Investor. Negative Filters. When Warren Buffett's mentor Benjamin Graham shifted his focus to enterprising investors, he recognized a fundamental truth. Avoiding bad investments matters more than finding spectacular winners. Research by Hendrik Bessembinder at Arizona State University found that just 4% of all publicly traded stocks generated the entire net wealth creation of the U.S. stock market from 1926 to 2016. The remaining 96% either lost money or merely matched treasury bills. While defensive investors accept market returns through diversified holdings, enterprising investors actively hunt for superior opportunities. This pursuit demands significantly more time, analytical skill, and emotional discipline. Graham's negative screening approach serves as the foundation for this more aggressive strategy, protecting capital by systematically eliminating companies that pose unacceptable risks. The first filter examines financial strength through debt-to-equity ratios. Companies carrying excessive debt relative to their equity face heightened bankruptcy risk during economic downturns. Consider Toys R Us, which collapsed in 2017 despite generating billions in revenue. The retailer's $5 billion debt load, accumulated through leveraged buyouts, made survival impossible when consumer habits shifted toward online shopping. Enterprising investors would have identified this red flag years earlier by calculating debt ratios exceeding Graham's conservative thresholds. Current ratio analysis provides another critical screening tool. This metric measures a company's ability to meet short-term obligations using current assets. When current assets fall below 1.5 times current liabilities, liquidity concerns emerge. Lehman Brothers maintained technically positive net worth until its 2008 collapse, but deteriorating current ratios revealed mounting liquidity pressures months before bankruptcy. Earnings stability represents perhaps the most important negative filter. Graham insisted on examining at least 10 years of financial data to identify companies with erratic or declining profit patterns. Theranos appeared revolutionary to many investors, claiming breakthrough blood testing technology. However, the company's refusal to publish peer-reviewed research and lack of transparent financial reporting would have triggered immediate rejection under Graham's screening criteria. Management quality assessment requires examining executive compensation relative to company performance, insider trading patterns, and corporate governance practices. When executives receive outsized compensation while shareholders suffer losses, red flags multiply. The 2001 Enron scandal demonstrated how elaborate executive compensation schemes often mask fundamental business problems. Geographic and industry concentration creates additional risk factors worthy of elimination. Companies deriving excessive revenue from unstable regions or declining industries face structural headwinds that superior management cannot overcome. Kodak's film photography dominance became a liability when digital cameras emerged, illustrating how industry leadership provides no protection against technological disruption. These negative filters work because they eliminate the worst-performing investments before analysis begins. By systematically avoiding companies with poor financial metrics, questionable management, or structural vulnerabilities, enterprising investors improve their odds of success while preserving capital for genuinely attractive opportunities. This methodical elimination process transforms active investing from speculation into disciplined business analysis. Part 4. Enterprising Investor: Positive Actions. After eliminating poor prospects through systematic filtering, enterprising investors must shift focus toward identifying genuine opportunities. Warren Buffett discovered this principle early in his career when he studied small insurance companies trading below their cash holdings. Rather than waiting for obvious bargains to appear, successful enterprising investors actively hunt for mispriced securities using 3 distinct approaches. The first strategy involves targeting secondary companies that receive minimal analyst coverage. In 1976, Buffett purchased shares in Geico when the insurer faced severe financial difficulties and traded at a fraction of its intrinsic value, while Wall Street focused on blue-chip stocks. This overlooked company represented exceptional value for investors willing to conduct independent research. Small and medium-sized enterprises often trade at discounts because institutional investors cannot purchase meaningful positions due to liquidity constraints. Special situations form the second category of positive action. These encompass corporate events like spin-offs, bankruptcies, and liquidations, where market inefficiencies create temporary mispricings. Joel Greenblatt documented numerous examples in his investment practice, including companies emerging from Chapter 11 reorganization, trading below their tangible book values. The complexity of these transactions deters casual investors, leaving opportunities for those capable of analyzing legal documents and financial statements. The third approach focuses on quantitative bargains, where statistical measures reveal undervaluation. Benjamin Graham pioneered this method by purchasing stocks trading below 2/3 of their net current assets, essentially buying businesses for less than their liquid assets minus all liabilities. Peter Lynch later adapted this concept at Fidelity Magellan, identifying retailers and manufacturers with low price-to-earnings ratios and strong balance sheets before institutional recognition drove prices higher. What separates these positive actions from speculation lies in the emphasis on thorough analysis and margin of safety. When Buffett invested in American Express during the salad oil scandal of 1963, he spent months interviewing restaurant owners and travel agents to understand the company's competitive position. This fieldwork revealed that customer loyalty remained intact despite the stock price decline. Successful implementation requires patience and discipline. These opportunities appear irregularly and may remain undervalued for extended periods. The enterprising investor must resist the temptation to force investments when attractive situations are scarce. Quality research takes time, and premature action often leads to poor outcomes. The key insight is that markets periodically misprice securities due to temporary pessimism, lack of coverage, or complex circumstances that obscure underlying value. By maintaining a systematic approach to opportunity identification while avoiding the pitfalls eliminated through negative screening, enterprising investors can achieve superior returns through informed, deliberate choices rather than market speculation. Chapter 3: Mastering Market Behavior and Investor Psychology. Part 1: The Mr. Market Allegory. When Benjamin Graham created his Mr. Market Allegory in the 1940s, he gave investors a framework that Warren Buffett would later call the most important concept in investing. Picture a business partner who shows up at your door every single day, wildly swinging between euphoria and despair, offering to buy your share of the business or sell you his share at whatever price matches his current mood. This imaginary partner, Mr. Market, behaves exactly like the stock market itself. On Monday, he might arrive bubbling with optimism, convinced your jointly owned ice cream shop is worth a fortune because summer's coming. He offers to buy your half for triple what you paid. Tuesday brings doom and gloom. Perhaps he read about a dairy shortage, and suddenly he's desperate to sell his share for half its reasonable value. The brilliant insight Graham provided was recognizing that you're never obligated to accept Mr. Market's daily offers. Unlike a real business partnership where you might feel pressured to negotiate, you can simply ignore his mood swings entirely. When Coca-Cola stock dropped 31% in 1987's Black Monday crash, the company didn't suddenly lose a third of its value overnight. People still drank Coke the next morning. Mr. Market had simply thrown a tantrum. Consider how this played out during the 2008 financial crisis. Amazon's stock plummeted from $94 to $35, yet the company's actual business, helping people buy everything from books to blenders, remained fundamentally sound. Investors who recognize Mr. Market's panic-induced pricing error could purchase shares at a steep discount from their intrinsic value. The key lies in developing what Graham called the proper temperament. Instead of matching Mr. Market's emotional intensity, successful investors cultivate detachment. They research companies thoroughly, calculate reasonable valuations, and wait patiently for opportunities. When fear grips the market and Mr. Market desperately wants to sell, they consider buying. When euphoria reigns and he's offering astronomical prices, they consider selling. Graham's student Warren Buffett exemplified this approach during the 1973 to 1974 bear market. While others panicked, Buffett calmly purchased shares in undervalued companies like the Washington Post. He later described feeling like an oversexed guy in a harem because opportunities were everywhere. The Allegory teaches investors to view market volatility as their friend rather than their enemy. Price swings create opportunities for those patient enough to wait and disciplined enough to act when others cannot. By treating Mr. Market as an occasionally useful servant rather than a wise guide, investors can profit from his mood swings instead of becoming victims of them. Part 2. Market Fluctuations and Investment Discipline. When the dot-com bubble burst in 2000, many investors watched their portfolios lose 30% or more in value. Those who panicked and sold at the bottom crystallized their losses forever. Yet those who maintained discipline during this turmoil discovered something remarkable. The very volatility that terrified others became their greatest wealth-building tool. Market fluctuations represent the single greatest test of an investor's character. Every major downturn creates two distinct groups: those who flee in terror and those who methodically purchase quality assets at discounted prices. The difference between these groups isn't intelligence or market knowledge. It's the ability to maintain discipline when emotions scream otherwise. Consider David Dremen's research spanning 40 years of market data. He found that investor returns consistently lagged market returns by 2 to 3% annually, primarily because people bought high during euphoric periods and sold low during fearful ones. This behavior pattern repeated itself during every major market cycle, from the 1987 crash to the 2008 financial crisis. The key to investment success lies in developing what Benjamin Graham called defensive habits. This means establishing rules when markets are calm and sticking to them when chaos erupts. John Templeton built his fortune by buying shares during the darkest days of World War II, when others believed civilization itself might collapse. His discipline during extreme uncertainty generated returns that compounded for decades. Successful investors treat volatility like seasonal weather patterns. They understand that market winters always follow market summers. When everyone else sees falling prices as disaster, disciplined investors see clearance sales. This perspective transforms volatility from an enemy into an ally. The most challenging aspect isn't identifying good investments during downturns. It's having the emotional fortitude to act. Peter Lynch observed that amateur investors often research stocks more thoroughly than professional appliances, yet abandon perfectly sound investment principles the moment prices decline. This contradiction reveals how fear overrides logic during market stress. Building discipline requires practical preparation. Successful investors often dollar-cost average during volatile periods, making regular purchases regardless of market sentiment. This mechanical approach removes emotional decision-making from the equation. They also maintain emergency funds separate from investment accounts, preventing the need to sell holdings during unfavorable conditions. The compounding effect of disciplined investing becomes most apparent over extended timeframes. Investors who maintained consistent buying patterns through multiple market cycles accumulated far more wealth than those who attempted to time market movements. This advantage compounds because they acquired shares at various price points, often obtaining excellent values during periods when others refused to participate. Market discipline ultimately separates temporary participants from lifetime wealth builders. Those who master this principle discover that volatility, rather than being their greatest obstacle, becomes their most reliable path to long-term financial success. Part 3. Diversification and Risk Management. When Benjamin Graham wrote about diversification in the 1930s, following the Great Depression, he witnessed firsthand what happened to investors who placed all their hopes in single companies or sectors. Thousands of affluent Americans lost everything because they concentrated their wealth in seemingly invincible stocks like Radio Corporation of America, which plummeted 95% from its 1929 peak. Graham's approach to risk management centers on what he called the margin of safety principle through intelligent diversification. This doesn't mean spreading money across hundreds of investments like throwing darts at a board. Instead, it requires thoughtful allocation that recognizes the fundamental uncertainty inherent in all investing. The most practical framework Graham advocated involves maintaining a balance between stocks and bonds, with the proportion shifting based on market conditions and personal circumstances. During the late 1960s bull market, when stocks reached dangerous valuations, Graham recommended defensive investors maintain at least 50% in bonds. Conversely, during market downturns like 1974, when quality companies traded below book value, increasing stock allocation to 75% made sense. Consider the experience of John Templeton, who applied Graham's principles during World War II. In 1939, when panic gripped markets, Templeton borrowed money to buy 100 shares of every stock trading below $1 on major exchanges. He purchased 104 companies, including 34 that were bankrupt. 4 years later, he had made money on 100 of those positions, quadrupling his investment. Graham cautioned against both extremes of concentration and excessive diversification. Owning 3 stocks in the same industry provides no real protection, as many technology investors learned during the dot-com crash when their portfolios of 10 internet stocks all declined together. Yet owning 50 stocks often dilutes returns without meaningful risk reduction, creating what Graham called diversification. The intelligent approach involves selecting 10 to 15 quality companies across different industries, combined with government bonds or high-grade corporate debt. This strategy protects against both market volatility and the specific risks that can devastate individual companies. Real estate investment trusts, utility stocks, consumer staples companies, and international holdings each respond differently to economic pressures. When inflation surged in the 1970s, energy stocks and real estate performed well, while long-term bonds suffered. During deflationary periods like the 1930s, the opposite occurred. The key insight Graham emphasized is that diversification should reduce risk without sacrificing reasonable returns. This means avoiding both the false security of government bonds during inflationary periods and the dangerous concentration that destroyed so many investors during market crashes. Proper diversification transforms investing from gambling into a methodical process of wealth preservation and growth. Part 4. The role of emotional discipline in investing. When Peter Lynch ran the Fidelity Magellan Fund from 1977 to 1990, he achieved an average annual return of 29.2%. Yet during his tenure, the average investor in his fund lost money. This paradox reveals the most important truth Benjamin Graham taught. Investment success depends less on intellect and more on emotional control. The mathematics of investing pale in comparison to the psychology of human behavior. Graham observed that most investors are their own worst enemies. They understand concepts like value investing and diversification intellectually, yet consistently make emotional decisions that destroy wealth. Consider the dot-com bubble of 1999 to 2000. Investors knew that companies like Pets.com with no profits were overvalued. But fear of missing out drove them to buy anyway. When reality hit, these same investors sold at losses, cementing their financial destruction through emotional reactions. The human brain evolved to respond quickly to immediate threats, not to think rationally about long-term investment decisions. This creates predictable psychological traps. During the 2008 financial crisis, investors pulled $230 billion from stock mutual funds in October alone. They sold at precisely the wrong moment, just before one of the greatest bull markets in history began. Fear hijacked rational thought, transforming temporary paper losses into permanent capital destruction. Greed proves equally destructive. In 1929, ordinary Americans mortgaged their homes to buy stocks, convinced prices would rise forever. This same pattern repeated during the housing bubble of 2006, when people with modest incomes bought multiple properties with no money down. Graham warned that intelligence becomes meaningless when emotions drive decisions. Successful investors like Warren Buffett have developed systems to counteract these psychological weaknesses. Buffett uses a simple rule: be greedy when others are fearful, and fearful when others are greedy. This sounds easy, but requires enormous emotional discipline. When everyone around you is panicking about losses or celebrating gains, maintaining opposite emotions feels unnatural. Graham suggested treating investing like a business partnership with an unstable partner, the market. Some days, this partner offers to buy your share at ridiculously high prices. Other days, he wants to sell his share at absurdly low prices. The key is recognizing these mood swings as opportunities rather than commands to act. A most effective strategy involves creating rules before emotions take control. Decide in advance what percentage of your portfolio belongs in stocks versus bonds. Determine specific criteria for buying or selling investments. Write these rules down when you feel calm and rational. Then follow them regardless of market conditions or emotional impulses. Professional traders understand this principle instinctively. They use stop-loss orders and position sizing rules to remove emotion from critical decisions. The moment they feel excitement about a potential gain or fear about a possible loss, they know their judgment has become compromised. Emotional discipline transforms investing from reactive gambling into proactive planning. It means accepting that you will sometimes feel uncomfortable with your decisions, especially when they contradict popular sentiment. This discomfort signals that you are probably making the right choice. Chapter 4. Security Analysis and Practical Case Studies. Part 1. Security Analysis for the Lay Investor. When Charles Munger evaluated Berkshire Hathaway's textile business in the 1960s, he didn't need advanced financial modeling software or years of Wall Street experience. He simply grabbed the company's annual report and applied 3 basic questions that any individual investor can master today. Most people believe analyzing company finances requires an MBA or sophisticated software, but Warren Buffett's mentor Benjamin Graham proved otherwise. During his teaching years at Columbia Business School in the 1950s, Graham watched ordinary students consistently outperform professional analysts by focusing on fundamental metrics that anyone can calculate with basic arithmetic. The foundation of security analysis rests on understanding what a company actually owns versus what it owes. Think of this like evaluating a friend's financial health before lending them money. You'd want to know their assets, debts, and monthly income, wouldn't you? Corporate analysis follows the same logic, just with larger numbers. Start with the balance sheet, which functions like a financial snapshot on a specific date. Assets represent everything the company owns, from cash in the bank to factory equipment. Liabilities show what the company owes to others. The difference between these two figures reveals shareholders' equity, essentially the company's net worth. Graham emphasized that companies trading below their net asset value often presented exceptional opportunities, much like buying a dollar bill for 50 cents. Consider the case of Geico in 1976. When Buffett analyzed the struggling insurance company, he discovered that despite its stock price collapse, the underlying business generated consistent profits and maintained substantial assets relative to its debts. The market had overreacted to temporary problems, creating an opportunity for those who could read the financial statements correctly. The income statement tells a different story, showing how much money flows through the company over time. Revenue represents total sales, while expenses include everything from employee salaries to raw materials. The bottom line, net income, reveals actual profits after all costs. Graham taught investors to examine several years of income statements, looking for consistent profitability rather than dramatic swings. Cash flow analysis adds another crucial layer. Companies can manipulate earnings through accounting techniques, but cash movements remain stubbornly honest. A profitable company that generates no cash often signals trouble ahead. Conversely, businesses producing steady cash flows typically indicate solid fundamentals, even if their accounting profits appear modest. Financial ratios transform raw numbers into meaningful comparisons. The price-to-earnings ratio compares stock price to annual profits per share. The debt-to-equity ratio reveals how much the company borrows relative to its net worth. Graham particularly favored the current ratio, which measures whether a company can pay its short-term debts using readily available assets. Modern technology has simplified these calculations dramatically. Today's investors can access financial data instantly through online databases that would have required weeks of manual research in Graham's era. Yet the fundamental principles remain unchanged. Buy companies selling for less than their intrinsic value, based on concrete financial evidence rather than market sentiment or speculation. The key lies in patient analysis and emotional discipline, not complex formulas or insider information. Part 2. Interpreting per-share earnings. When Enron reported earnings per share of $1.47 in 2000, investors celebrated what appeared to be robust profitability. Yet within months, the company collapsed, revealing that those earnings were largely fictional. This stark example demonstrates why smart investors must peer beyond the headline earnings per share number to understand what truly drives a company's financial performance. Earnings per share represents a company's net income divided by the number of outstanding shares. While seemingly straightforward, this metric can be manipulated or distorted in ways that mislead even experienced investors. Consider how companies often engage in share buybacks not to improve operations, but simply to reduce the denominator and artificially inflate per-share earnings. IBM executed this strategy extensively between 2005 and 2020, spending over $140 billion on buybacks while revenues declined consistently. Graham emphasized distinguishing between ordinary and extraordinary items within earnings reports. A pharmaceutical company might report exceptional gains from selling a subsidiary, boosting that year's earnings dramatically. However, such one-time events provide no insight into the company's ability to generate sustainable profits from core operations. Microsoft's 2021 earnings included a $1.2 billion gain from selling part of its mapping business. Impressive on paper, but irrelevant for evaluating the company's ongoing software and cloud capabilities. Accounting methods further complicate earnings interpretation. Companies can legally choose different depreciation schedules, inventory valuation methods, or revenue recognition practices that significantly impact reported earnings. Amazon, for instance, capitalizes certain development costs that other retailers expense immediately, making direct earnings comparisons challenging without adjustments. The concept of normalized earnings becomes crucial here. This involves averaging earnings over several years to smooth out cyclical fluctuations and temporary distortions. Ford Motor Company's earnings swung from losses exceeding $12 billion during the 2008 financial crisis to profits of nearly $7 billion in 2011. Neither figure accurately represented the company's typical earning power during this period. Quality of earnings analysis requires examining cash flow statements alongside income statements. Companies reporting strong earnings but weak cash flows often signal potential problems. Xerox famously reported steady earnings growth in the late 1990s while cash flows deteriorated, foreshadowing accounting irregularities that eventually surfaced. Graham also warned against the dangers of pro forma earnings, where companies exclude various non-recurring charges to present more favorable results. During the dot-com era, many technology companies reported pro forma profits while showing actual losses under standard accounting principles. The most reliable approach involves focusing on earnings from continuing operations, excluding one-time gains or losses, and comparing these figures across multiple years. This methodology reveals whether a company generates consistent profits from its core business activities rather than financial engineering or accounting creativity. Such disciplined analysis protects investors from the costly mistakes that often accompany surface-level earnings assessments. Part 3. Stock Selection and Company Comparisons. When Warren Buffett calls Benjamin Graham's stock selection principles the bedrock of sound investing, he speaks from decades of applying these methods to build Berkshire Hathaway's extraordinary returns. The challenge lies not in understanding individual metrics, but in weaving them together into a coherent evaluation framework that reveals genuine investment opportunities while avoiding value traps. Graham's approach begins with establishing minimum quantitative standards that filter the investment universe. He insisted that defensive investors should only consider companies with current assets exceeding current liabilities by at least twice the amount, ensuring sufficient liquidity during difficult periods. General Electric demonstrated this principle during the 2008 financial crisis, where its strong balance sheet allowed the company to maintain operations while competitors struggled with funding shortages. The price-to-earnings ratio serves as the initial screening tool, but Graham emphasized comparing PE ratios within industry contexts rather than using absolute benchmarks. During the 1990s technology boom, investors who applied blanket PE limits missed legitimate opportunities in software companies that commanded higher multiples due to superior growth prospects and asset-light business models. Microsoft, trading at seemingly high PE ratios throughout the 1980s and 1990s, consistently delivered exceptional returns because its earnings growth justified the premium valuations. Debt-to-equity ratios require careful interpretation across different industries. Utility companies like Consolidated Edison historically carry higher debt loads due to their capital-intensive infrastructure requirements and predictable cash flows, while technology firms typically maintain minimal debt levels. Graham advocated for debt ratios below 50% for industrial companies, but recognized that each sector presents unique capital structure norms. The most revealing comparisons emerge when examining return on equity trends over 5 to 10-year periods. Companies demonstrating consistent ROE above 15% without excessive financial leverage often possess genuine competitive advantages. Amazon's evolution illustrates this principle perfectly. Despite years of minimal profits that concerned traditional value investors, the company's consistent reinvestment in logistics infrastructure and technology platforms eventually produced sustained high returns on equity, validating its long-term business strategy. Graham's methodology shines brightest when comparing companies within identical industries facing similar market conditions. During the airline industry's restructuring in the early 2000s, Southwest Airlines stood out through superior debt management, consistent profitability, and efficient operations while competitors filed for bankruptcy. The company's financial metrics revealed operational excellence that translated into superior shareholder returns. Book value comparisons provide additional insight, particularly for asset-heavy industries like manufacturing or real estate. However, Graham warned against mechanical application of price-to-book ratios without considering asset quality and earning power. Many financial institutions appeared attractively valued on book value metrics before the 2008 crisis, yet their assets proved far less valuable than balance sheets suggested. The synthesis of these quantitative measures with qualitative business assessment creates a comprehensive evaluation framework. This approach transforms stock selection from speculation into methodical analysis, providing the foundation for intelligent investment decisions that withstand market volatility and deliver long-term wealth creation. Part 4. Real Case Histories and Lessons Learned when Continental Can Corporation traded at $18 per share in 1949. Most investors saw a struggling packaging company fighting labor disputes and declining margins. Benjamin Graham's students, however, recognized something extraordinary. The company's working capital alone exceeded its entire market value by $30 per share, creating what Graham called a bargain issue. This real-world application of value principles would generate returns exceeding 300% over the following decade. The Northern Pacific Railway case from 1901 offers another compelling lesson in Graham's analytical framework. While speculators battled for control, driving shares to astronomical heights, careful analysis revealed the railroad's true asset value lay buried in its vast landholdings. The company owned mineral-rich territory across 7 states, yet the market valued these assets at practically zero. Patient investors who calculated intrinsic value based on actual holdings rather than operating metrics, captured enormous gains when the market eventually recognized this hidden wealth. Consider the contrasting fate of Penn Central Railroad, which Graham's disciples avoided despite its apparent statistical cheapness in the late 1960s. The company traded below book value and showed positive earnings, seemingly fitting value criteria. However, deeper analysis revealed deteriorating infrastructure, massive hidden liabilities, and questionable accounting practices. The railroad's 1970 bankruptcy demonstrated why Graham insisted on examining debt levels, working capital trends, and management quality alongside simple price metrics. Graham's own investment in Government Employees Insurance Company illustrates the power of combining quantitative analysis with qualitative assessment. Geico's direct marketing model created sustainable competitive advantages that traditional metrics couldn't capture. Graham recognized that the company's lower customer acquisition costs and superior loss ratios justified premium valuations relative to other insurers. His initial $720,000 investment eventually returned over $400 million, proving that understanding business models matters as much as calculating ratios. The dot-com bubble provides modern validation of Graham's margin of safety principle. Companies like Pets.com commanded billion-dollar valuations despite minimal revenues and no path to profitability. Traditional value investors who adhered to Graham's teachings avoided these speculative darlings entirely. When the bubble burst, disciplined analysis protected capital while growth-focused strategies suffered devastating losses. Even seasoned practitioners learned costly lessons when they strayed from core principles. The 1974 oil crisis caught many value investors holding energy stocks that appeared statistically cheap but faced permanent demand destruction. Those who maintained diversification and avoided concentration in single sectors weathered the storm better than specialists who violated Graham's risk management guidelines. These historical examples demonstrate that successful value investing requires more than mechanical application of formulas. The intelligent investor must combine quantitative screening with business judgment, maintain discipline during both bull and bear markets, and never forget that preserving capital remains the primary objective. Markets may evolve, but Graham's fundamental insights about human psychology and business valuation continue protecting investors from costly mistakes while identifying genuine opportunities.